Welcome to this audio flip chart on the impact of managerial overconfidence on the perceived cost of capital charged by the capital market. My name is Manfred Frühwirth. I'm Professor of Finance at WU Wien, which is Vienna University of Economics and Business. The purpose of this audio flip chart is to illustrate how the overconfidence of a manager affects his perception of the cost of capital charged to the company by the capital market. In general, when we talk about the cost of capital, we have to distinguish between the cost of equity, the cost of debt, and the weighted average cost of capital, which is also called the WACC. The cost of equity and the cost of debt are two major components that enter into the WACC. And the WACC is a relevant number both for the capital structure choice and for the investment decisions made by the manager. Moreover, looking at the cost of capital with a wide behavioral corporate finance horizon, there are two different versions of the cost of capital. One is the fundamental cost of capital. This is the cost of capital that is appropriate for the risk of the investment project. The other version is the cost of capital that is charged to the company by the capital market. This is the cost of capital that the shareholders and the debt holders are charging to the company. This can be calculated implicitly based on the stock prices and on the bond prices. In behavioral corporate finance, the fundamental cost of capital and the cost of capital charged by the capital market may deviate from each other. This audio flip chart focuses on the cost of capital charged to the company by the capital market. Therefore, we talk about the cost of capital derived implicitly from the prices on the financial market. So you observe the stock prices and the bond prices in order to find out how much the shareholders and the debt holders are charging the company. Let us come to this flip chart. And let us first of all ignore all the blue and black arrows and all the red equal signs. The white area on the flip chart shows one investment project. This is just one example that is representative of all the investment projects carried out by the manager. We see time zero and we see the future points in time, as well as the initial outlay and all the expected future cash flows from the investment project. The green box below relates to the equity component. So here we are dealing with the company's stock. This part is relevant in order to derive the cost of equity. To calculate the cost of equity charged to the company by the capital market, we use a very simple model, namely the constant growth dividend discount model. According to this model, the stock price, symbolized by P0, is the first expected dividend, symbolized by div1, divided by the cost of equity, symbolized by KE, minus the future growth rate of the dividend, symbolized by G. On the right-hand side, we see how to rearrange terms in order to calculate the cost of equity that is consistent with the price at stock exchange. This is called the implied cost of equity, or the cost of equity charged to the company by the shareholders. The resulting formula for the implied cost of equity is very simple. Take the first expected dividend and divide it by the current price of the stock. This is called the dividend yield. Finally, add the growth rate. That's it. The orange box below relates to the debt component. So here we are dealing with the company's bonds. This part is necessary in order to derive the cost of debt. To calculate the cost of debt, charged to the company by the capital market, we use the equation that gives us the expected yield to maturity. According to this equation, the bond price, symbolized by P0, is the present value of all expected future coupons, symbolized by E of C, and of the expected repayment, symbolized by E of R, both discounted with the expected yield to maturity, symbolized by YTM. In general, there is no explicit solution of this equation, but you can solve it, for instance, with Excel or with a financial calculator. This expected yield to maturity is the implied cost of debt, or the cost of debt charged to the company by the debt holders. Note that the expected yield to maturity is slightly different from the promised yield to maturity, based on the promised cash flows, that is often used in practice. However, using the expected yield to maturity is more precise. On this flip chart, the red equal signs are used for the variables that are not affected by the overconfidence of the manager. The black arrows show the misperceptions of the manager resulting from his overconfidence, and the blue arrows show the resulting impact on the cost of capital charged to the company by the capital market, as perceived by the manager. Let us carefully investigate the impact of managerial overconfidence on the perceived cost of capital charged by the capital market. First, the overconfident manager overestimates the success of his investment projects. This is shown in the white area at the example of this specific investment project. As is illustrated by the black arrows, the manager overestimates the expected future cash flows. As a result of this too positive view on his investment projects, the manager also overestimates the dividends that the company can pay out to the shareholders in the future years. So he overestimates the next year's dividend, div1, and probably also the growth rate G. This is shown by the black arrows. As the stock price is an exogenous number that results from supply and demand on the stock market, there cannot be any misperception by the manager. From these effects, it is clear that the implied cost of equity, as perceived by the manager, goes up because of his overconfidence. 2 out of 3 drivers increase and the third one remains constant. As the managers overestimate the future dividends and growth rates, they have the feeling that the capital market charges them too much for the equity. Due to the overestimation of his investment projects, the manager also underestimates the probability that the firm goes bankrupt in the future. This makes him overestimate the expected coupons and the expected repayment of his bonds. This is shown by the black arrows. As the bond price is an exogenous number that results from supply and demand on the bond market, there cannot be any misperception by the manager. From these effects, it is clear that the expected yield to maturity has to go up. If the numerators go up and the overall result has to stay the same, the denominators have to go up too. Therefore, the manager's perception of the expected yield to maturity, which is the cost of debt charged by the bondholders, goes up. So as the managers underestimate their bankruptcy risk, they have the feeling that the capital market charges them too much for the debt. What is not explicitly shown on this audio flip chart is that this effect of overestimation of the cost of capital charged by the capital market is stronger for the equity than for the debt. This comes from the fact that the claims of the equity holders are far more sensitive to the well-being of the company than the claims of the debt holders. For the debt holders, the only thing that matters is if the company survives the coupon dates and the repayment date of the bond. So the gap between the perceived and the actual cost of capital charged by the capital market is bigger for the cost of equity than for the cost of debt. To put it differently, in the perception of the manager, the cost of equity charged by the capital market is exaggerated more than the cost of debt. Summing up, we saw on this audio flip chart that overconfident managers overestimate the expected cash flows from their investment projects, and as a result, they overestimate the cash flows that their shareholders and debt holders can expect to receive in the future. Therefore, from the perspective of the overconfident manager, both the cost of equity and the cost of debt charged by the capital market are excessive. It goes without saying that this misperception may have an impact both on the investment decisions and on the capital structure decisions of the manager. We have to keep in mind that this is only the perception of the overconfident manager. A rational manager would not overestimate the expected future cash flows from the investment projects. As a result, he would neither overestimate future dividends and growth rates, nor would he underestimate future bankruptcy probabilities. Therefore, he would not perceive the cost of capital charged by the capital market as too high. I hope you enjoyed this audio flip chart. Thank you very much for watching.